ETFs are booming, with more than 1,200 launches expected this year in the US, over $1 trillion in global inflows year to date, and more choice than ever. But how much of that growth is actually improving outcomes for clients? Hi, I'm Carole Okigbo. In this video, we'll explore what real progress looks like in today's ETF market, why durability matters much more than novelty, and how advisors can stay focused on delivering long-term outcomes for their clients. The numbers are undeniable. U.S. ETF launches are on pace for over 1,200 this year, and globally, ETF inflows have crossed the $1 trillion mark year to date, and this is in an industry that is over $23 trillion and still growing rapidly. But what's interesting is that the nature of flows is starting to shift. We're seeing signs of rotation rather than just pure growth, with flows moving from U.S. equities to more international exposures and increasingly into fixed income and active ETFs as investors continue to navigate this higher for longer rate environment. So coming back to the main question, from an advisor perspective, progress really comes down to three main things. First, better outcomes for clients. More products do not automatically improve portfolios. It's all about whether the ETFs can actually help with diversification by including more global exposure, risk management in a more volatile, geopolitically complex backdrop, or assist with income generation in a higher rate world. Secondly, clarity over complexity. The ETF universe now spans everything from core beta to highly complex, outcome-oriented strategies. Progress is when innovation actually makes portfolios easier to understand, not harder. And thirdly, the quality of implementation. Not all ETFs are created equally. With higher rates, more dispersion across markets, and increased trading volatility, factors like liquidity, bid-ask spreads, tracking error directly impact client outcomes and costs. So for advisors, real progress isn't about keeping up with every new launch. It's about being more intentional, using ETFs with discipline, understanding how they work under the hood, and focusing on the handful of exposures that truly improve client portfolios. That is where the industry moves from growth to real progress. If you look back over the last decade, there's a pretty consistent pattern. Hundreds of ETFs launch every year, but only a subset really scale and endure. And over time, roughly a third of all ETFs created have actually been shut down. What separates the ones that land is not novelty. It's actually durability and ultimately whether they solve a real persistent problem for investors. I tend to break it down into a couple of areas. First, having a clear role in the portfolio. The ETFs that last solve a real problem. They provide core beta. They provide income. They help manage risk. The ones that fade often start with a theme or idea, but no repeatable role in a portfolio. Second, efficient execution. Advisors gravitate to products that are easy to trade and are reliable. They have tight spreads, strong liquidity, and dedicated support from market makers and APs. These characteristics directly impact client outcomes, so they win over time. Third, consistency of use. Again, the products that scale are the ones that advisors can come back to repeatedly, whether as a core building block or for specific outcomes. One stat that really reinforces this is that in recent years, only about 10% of active ETFs grew to $100 million within their first year, which is the threshold for long-term success. Now, launches may drive attention, especially in this record-breaking year, but it's really the utility, repeatability, and implementation quality that drives survival and scale. In a more mature ETF market, I think meaningful innovation looks much less about newness and much more about usefulness. So early on, innovation was all about access, bringing exposures to the ETF wrapper. Today, a lot of exposures already exist, so the bar is arguably much higher. Innovation has to improve how portfolios are built and how they perform. I tend to see it in three main areas. First, precision in portfolio outcomes, whether that's more targeted income, risk management, or defined outcomes. The big question is, are we enabling advisors to express an allocation more efficiently than they could before? Second, better implementation. In today's environment, with more volatility and dispersion, execution quality is increasingly front and center. That's where structure and capital markets matter. Lower costs, tighter spreads, deeper liquidity, and a strong ecosystem may sound incremental, but they compound meaningfully for clients over time. And finally, integration into portfolio construction. The innovations that stick are the ones that fit naturally into how advisors build portfolios, not adding complexity, but simplifying decision-making and improving the consistency of use. So for advisors, the opportunity here is to be more selective, to focus less on what's new and more on what's enduring. The products that ultimately win are the ones that consistently deliver on portfolio outcomes, integrate seamlessly into portfolios, and trade well across different market environments. Now, this is really the central challenge today because advisors have way more flexibility than ever, but that flexibility can easily turn into complexity. What we're increasingly seeing, especially in today's environment, is that the best advisors are anchoring that flexibility within a very clear structure. And typically, that starts with a disciplined core, broad, low-cost ETFs that drive the majority of long-term outcomes through asset allocation and diversification. Then they use that expanded toolkit more selectively in satellite exposures to express views, manage income, adjust risk, without disrupting the integrity of the overall portfolio. And that's become even more important recently as markets have become very sensitive to rates, macro data, and geopolitical shifts. So the conversation is really shifting from how many ETFs should I own to what role does each ETF play? Because in a world of thousands of choices, role clarity matters far more than access. And importantly, we're seeing advisors evolving in that direction. Yes, they're adding more ETFs, but they're doing so on top of a disciplined framework, not in place of one. The way I think about it is flexibility should really enhance your discipline, not replace it. If every ETF in the portfolio has a clear purpose, has defined size, has a role in achieving client goals, you can actually take advantage of innovation without losing sight of your long-term outcomes. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.